students, we're going to look at the investment and financing cycle today. Okay, so where we are in the process right now is we have completed our pre-engagement activities and we've done the planning of the audit. When we started the cycles, we went into step 3, which was performing the audits. Okay, so we have subdivided this into part A and B, which is 1, the controls, and then 2, the substantive procedures. Okay, the reason being is that in order to execute or perform any audit, the auditor needs to be able to test any controls that the client has implemented, or failing which, if there are no controls in existence at the client or the controls do not operate effectively, the auditor can then do substantive procedures to confirm the balances and transactions. So we've said we are on step 3 and we have done some of the cycles and we still need to complete the rest of the cycles. That is the focus of the first semester, to get the cycles and the characteristics, the documentation per cycle, the controls and the testing of the controls, as well as the substantive procedures for each cycle, to make sure that we are 100% comfortable with each of these in order to be able to obtain audit evidence. Okay. Resources. The module notes are quite nice, and please do remember that you are still welcome to book consultations. Just to send me an email and we can arrange a time to have a specific consultation with you. Okay. Each cycle we set the characteristics and activities in the cycle are important so that we are able to, when we put our management hat on, to be able to design controls, okay, and if we put our auditor's hat on, we should be able to then test those controls and then perform substantive procedures as well. Okay, so what makes the investment and financing cycle different to the cycles we've done before is the fact that they have very few transactions. Okay, this is not your routine type of transactions that an entity would normally have. Okay, those day-to-day activities like sales and purchases, and even banking cash as well could also be a daily or a routine cycle. Okay, but investment and financing happens quite sporadically throughout the year, okay, as the need should arise. Okay, but what makes it a little bit more risky is the fact that it has material transactions, okay, and balances, and these could obviously be susceptible to fraud and error, but also because we have statutory obligations as determined by the Companies Act and other relevant laws and regulations. Okay. Okay, so what is important in this cycle is the nature of the assets and the significance thereof. Obviously, then additions and disposals, we need to think about the funding. That's why there's also a financing component. Okay, and then obviously there needs to be a strategic plan for not just the replacement of assets, but the growth or the expansion strategies that management would like to implement. Okay. So if you think of your statement of cash flows, this is now from financial accounting. If you think of your statement of cash flows, this is then your investment activities and then your financing activities. So if you think about the line items that you see here, or even if you look at your statement of financial positions, your non-current assets as well as your non-current or maybe even current liabilities. Okay. Okay, we said already we have investment activities and financing, and then the types of transactions that we would expect in investment activity would be listing of assets, your disposals, depreciation, revaluation, impairment. Those are your non-cash flow items, okay, that if you were to do your cash flow statement On an indirect method, those are your non-cash flow items that you would need to adjust for to get back to your profit before tax, cash generated from operations then. Okay, maintenance and improvements, those are cash-based then. Okay, so in terms of our documentation, for a whole range of documents that are applicable, for your investment activities, the capital budget that has been set out for the year is quite important. You have fixed asset requisitions. A requisition is just another word for request. The minutes of the board meeting, your invoices, your fixed asset register, very, very important. And then, like we've said, your general ledger accounts or your line items on your statement of financial position, that is important as well. Okay. So we divided our activities into three main categories: your acquisitions or additions, your disposals, and then the repair and maintenance. Okay, so these are all then subsequent activities, the disposals, repair, maintenance, and improvements, where additions would then usually be your initial recognition. Okay, for additions, you would need a formal written proposal by the CapEx committee if it is a large organization, CapEx being the capital expenditure committee. Not every organization or institution has this committee, depending on the number of employees that are employed at the organization. Okay, but this committee is important because its sole focus is to look at the capital needs of an organization, whether there is any need for replacement or maintenance or an expansion strategy that needs to be implemented. Okay. This proposal is supported by quotes, depending on the policy of the company. It could be 3 quotes, and then supporting that would then be the source of funding that would be needed to fund this the acquisition basically. This is presented to the board of directors, and they are then tasked with making the decision. That decision needs to be minuted, and you should, if the auditor comes in to test this, they should be able to find that in the approved minutes. Okay. Remember, like we said, a larger organization could have different levels of authorization. For example, your mere office furniture would not necessarily be needed to be presented to the board of directors for approval if you are replacing the office furniture. Okay, so let's say there could be different thresholds. For example, any capex below 10,000 would probably only need the approval of the line manager. Anything above 10,000, between 10 and 100,000 would then be perhaps EXCO, the executive committee, and then any capital expenditure above 100,000 would then be presented by the capex committee to the board of directors for approval. Okay, so for additions then we would need the contract, the signed contract. Okay, this is especially important for material additions. Think of the construction of a building or a factory, or the acquisition of a fleet of vehicles. There would need to be a signed contract in place. For additions that are not as significant in value, an invoice would usually then suffice. So for under lease, you have to be very mindful of the fact that there are requirements as per IFRS 16, and the accounting needs to then be correctly accounted for in the records. Okay, so in terms of the lease agreement, or the contract that is signed between the two parties, those terms and conditions need to be reflected in the accounting records. Okay. photos